If you feel like you took the crazy pill when it comes to what's going on with the markets, inflation, interest rates, and our economy in general, you aren't alone. A lot of us average investors have a feeling like something isn't quite right. So, what's going on and what can you do to thrive in this economy? That's what we're getting into today. Hi, welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're discussing investment strategies to help you thrive in this crazy economic environment we're in right now. Now, Brian, you have almost 3 decades of trading experience and 24 plus years as a financial advisor. Let me start with this question. The Fed keeps raising rates, but in January, inflation rose 0.5%. The PPI, the CPI, and retail sales were all hotter than expected in February. Unemployment is at 40-year lows, but major companies are laying off a ton of workers. And then we have major banks calling and Wall Street calling for a recession. So, as I said before, something doesn't feel quite right here. It doesn't add up. So, what the heck is going on?
Yes, Michelle. That's because we're in unprecedented times. Okay, let's put it this way. We've never seen an economy shut down like we did from 2020 to 2022. And that caused massive changes to our economy. You know, traffic ceased, people stopped going to work. And then you've seen the largest amount of stimulus to ever be dumped into the economy by our Federal Reserve. And don't forget the emergency unemployment benefits. Even self-employed people got unemployment during that time frame, Michelle. And then all the extra child care credits for families. Let's take it one step further. We also had the largest Social Security COLA increase in history, and due to the high inflation. Guess what? That money, they don't claw that money back. It's already out there. And then payments will now continue at them higher rates forever. That money will never return to the system. Okay. Think about this. During them shutdowns, companies scrambled to get workers. But now what's happening? You mentioned it. They're laying them off. Why? Because they overhired.
Yeah. So, question for you on that. Is it normal that when companies announce layoffs, their stock prices rise the next day? Because that's at least what I'm noticing. I'm also noticing there's no the sky is falling type reaction as we've seen before when you see layoffs this big. Something just feels off. What's that all about?
Actually, Michelle, it's doing this because it brings down expenses, which makes the balance sheets look better. And me as an investor, I'm thinking, oh, okay, they're cutting out their expenses. That's even better. That's more money to the company and we can grow, right? And think about this. People are getting hired right back again. Okay. There's no shortages of jobs right now. And talk about a shift in the mindset of workers. Raise the raises people have gotten to an unbelievable amount just to get people to come back into the workforce.
Right.
Unemployment numbers are still falling.
Yeah, you talk about the shift in mindset of workers. I know so many people who are being called back into the workforce, and a lot of them are just quitting because they know that they can find another job that doesn't require that
tomorrow, and one that will allow them to continue the environment that was created, which was the work from home environment. So
sure. So, quick question on all this: what is the market saying right now, so to speak, about all this?
And let's talk about the Fed. We don't trust the Fed right now because nothing makes sense. They're losing confidence in the Fed.
The market is. The market is, correct?
Yeah, the market is. And think about this. Some of the questions, are they going to drive the economy down to a recession just to reach their 2% inflation goal? There's no way that this much money in the system was ever going to be accounted for. And let alone, Michelle, we're getting 100% wage increases. Okay. We feel at times that they're going to, I don't know, are they going to completely destroy our economy just to meet their 2% inflation goals that they may never reach again?
Well, it makes you wonder if that is the end goal. I mean, do they actually want to destroy it? What better way to usher in a CBDC? Oh. They create the mess and then they save us.
They've done it before.
Yeah,
and I'll say this. We had 7 rate hikes in 2022 and 1 so far this year. That's 8 rate hikes for a total of 4.5% increase in rates, right? We haven't seen the lagging effect of this and may not for another 12 months. But if the Fed keeps raising rates, there's a lot of calls for them to, whoa, you better slow down. Let's wait and see how all this trickle down effect works before you overshoot the wad.
So if it feels like you can't wrap your head around what's going on, that's because we're in an economic environment we've never been in before. Is that what basically to recap what you said?
Right. At least not to this extent.
Yeah.
We've been through recessions before and high interest rates and inflation before, but this is a whole different ball game here right now. So
yes, it is. All right. So Brian, let's get to the point of this video. How does the average investor navigate the waters and thrive right now?
okay. Before I get to that, I think it's important to talk about what typically happens in a normal inflationary and high interest rate environment, because you don't want to throw the baby out with the bathwater, right?
No, you don't.
Just because we aren't in normal times doesn't mean that some of these strategies that have worked in the past won't still work now. So here's what's worked in the past during volatile times. We've talked about, if you watch this channel anytime at all, we've always talked about diversifying your portfolio.
Right.
And one of the most effective ways to protect your investments during periods of market volatility, inflation, and rising interest rates is to diversify. Also, we've talked about investing in inflation-resistant assets. Certain asset classes are more likely to perform well during periods of inflation. It's that simple. Kind of like real estate, commodities, stuff like that, energy, materials. Also, you may want to consider alternative investments. They've performed well during heightened states of inflation like this. Some of them are like private equity and hedge funds, venture capital. Also, managing risk during this time. It's essential to manage your risk carefully. And you could set stop loss orders. So if the market falls down further, it would sell, and you just need to stay on top of your portfolio. Right. Also, during these heightened times, Michelle, investing for the long term. Stop looking at what's happening 3 months, 6 months, 9 months out, and start looking 5 years out, 10 years out, and 20 years out. It's that simple. And then also during these times always look at defensive stocks. So like cyclicals and healthcare, utilities, consumer staples. So,
okay. So that's what has worked in the past during volatile
in a typical environment like this. Yes.
Okay. So now what is my question? What strategies might work now? And I say might because who the bleep knows what's going on. And unfortunately, you and I aren't fortune tellers.
But we do have brains and eyeballs.
Yes, we do. We do.
Last I checked. If the market feels inflation has peaked and the Fed is near the end of its tightening cycle, there are several strategies to consider. Remember, the market is 6 months out already and predicting where the Fed will be 6 months from now.
Okay.
So the market's already front running where they feel the Fed is going to be. So things like rebalancing your portfolio. If you had inflation resistant assets in there, commodities, real estate, you want to start to rebalance that portfolio away from that. Okay. And going back into growth oriented investments, because that's what's going to drive us out of an inflationary environment the quickest.
So what's a growth? What does that look like?
That'd be like the stocks like that were in the NASDAQ, the technology, the growth companies, ones that their earnings are going to grow faster than the overall market. So,
okay.
And also high quality companies, the best of breed in whatever technology it may be, like chips or the automotive, the EV industry, Tesla, stuff like that. So
these would be high quality companies would be those with strong balance sheets,
strong balance sheets. Yes.
The management team too is important, correct?
Yeah, it is. And then also look at companies that have they're generating revenue.
Sure.
First of all, you're not going to get out of this if you don't have revenue coming in. It's that simple.
Right.
And then you yourself need to step back and review your own debt strategy. Okay. Think about that. Considering refinancing that high interest credit card debt and take advantage of lower interest rates when it does come down. Okay. And prepare for the unexpected. That's a big thing we talk on this channel a lot about, having emergency funds just in case things do shift even more negative. So
Absolutely. I mean, talking about the debt strategy, the amount of Americans who are currently borrowing more right now is really terrifying. And that
It
the,
is.
the, the credit cards are actually they're extending lines of credit more and more and
Which
more. So that's something just really be careful of. I looked at a credit card statement that I have, and I pay it off every month, but I was shocked at how much. And it hadn't gone up that much, but I was like, wow, if I had $10,000 balance on this, I did not want to pay 18 point whatever percent it was. And it had gone
exactly.
up from 13.
And you're in the same situation as me. Uh, we get the statements all the time, and one recent one is, Brian, we notice your spending habits, and
Yes.
and I'm big on rewards, so give me them airline miles because I
Sure.
travel. So, but it said you're paying it off every month, so we're going to extend your credit line and make it larger, much larger. Okay, thanks, but I'm still not going to change my philosophy of spending. But thanks anyway. So
Yeah.
they're trying to draw you into that. So
Yeah, absolutely. So just be cautious, everyone.
right.
All right. Let me ask you one last question. This is a big one. What investments will thrive after the Fed is done rising rates? Now, I know you're not again, we're not fortune tellers. You can't see the future,
Where's my
but
crystal
what,
ball at?
what are your thoughts on this?
My
Right?
crystal ball.
Yeah.
It's a tough one because
My magic 8 ball says,
I used to have one of them when I was a kid. I love
agree.
that thing. But there's so many different variables at play here, Michelle. Predicting which investments will thrive first.
Sure.
It can be highly unpredictable due to market conditions and all the other economic factors that we can't control. However, there are several investment categories that have historically performed well in a rising interest rate environment. And let me, real quick, do you think the economy is doing well if the Federal Reserve is raising interest rates?
I mean, all signs point to it's doing well.
In a normal tightening cycle, the economy usually does very well during an interest rate tightening cycle. History has shown that.
Okay.
And the market does well also. And here's some of the ones that have performed well. Financials. Why would financials do better during a tightening cycle? Because their
Mhm.
balance sheets are increasing. And like we just talked about, they're extending more credit lines at a higher rate.
Yeah.
They make more money off of that debt.
Yeah.
Second,
That was my ding 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 moment because they're making more money.
they're making more money.
Yeah.
And do you think they want to did you see them increasing credit lines when interest rates were at 40-year lows?
No.
No, you're
No.
seeing it now. Why? Because they can make more money.
Sure.
Second, and let's can I take that one step further real quick, Michelle?
Sure. Yeah, go for it.
Okay, think about this. If remember 08, 09,
Yes.
that was bad. That was bad, right? Well, they were pulling back on lending, cutting off credit lines, doing all that. They did that because there was so much uncertainty with the economy. If they're increasing your credit lines now, do you think that they think the economy is doing well? And the money will be coming back to them in higher interest payments? They do. They do. So,
Interesting then that they are all calling for this massive, horrifying recession.
yeah, okay. Yeah. Do you
Okay.
believe?
Okay,
You
let's keep
can't,
going. So
yeah.
we're talking about what may perform well after the Fed has completed its tightening cycle. So we talked financials. What else is next?
Technology, definitely
Okay.
technology, because they have little debt and they're less sensitive to interest rate changes.
Okay.
Consumer discretionary, companies that produce discretionary
Sure.
goods such as automobiles, luxury goods, and travel. And guess what? We're seeing that right now with these earning reports that just came out. Every one of that companies that were in them categories we just mentioned, Michelle,
Sure.
are increasing right now. That's a good thing. That shows we're nearing that end of that cycle.
Okay.
Also, energy and materials. They benefit from a strong economy and a rise in demand. Well, if the economy's still doing well, lumber's still going to go back up, copper's going to go up, and people are going to invest into them and they're going to be still spending.
Okay.
Also, emerging markets, the emerging markets like overseas. You're looking
Sure.
at long-term world economic growth. So
Okay, and those tend to perform well in a rising rate environment.
yeah, a little bit riskier and more volatile,
Yeah.
but they still perform well. So
Okay. All right. So how does one, I guess, the list you just rattled off there, how does one pick the right investments for
well,
their specifically goals? I mean, what
yeah.
do you
Well, and think about this. Number one, what's your time horizon? When do
Okay.
you need access to these funds?
Okay.
If it's 3 months, 6 months from now, no, you shouldn't be in the market anyways. You should be in short-term savings accounts, right?
Right, sure.
But if you're looking 5 years, 10 years, 20 years to
Okay.
retirement, no, these are the best times to be looking at making that transition to companies that are going to be more friendly to and perform well when the Fed stops their tightening cycle.
Okay. All right. So this is really good stuff. Thanks so much, Brian. We are going to drop a link to a video we just did on the dangers of central bank digital currencies, CBDCs. Check that out. It's in the description below and also the pinned comment. It flows nicely from the video we just did today. So
Oh yeah.
also, if you've made it this far, I would like you to hit that like button, show us you like the content that we produce. Don't forget to subscribe. Brian and I put out videos on the daily that will help you make better financial decisions for your future. And also leave us a comment. Let us know what you're doing right now, what you plan to do. We're always answering those. All right, Brian, as we wrap this up, any parting words of wisdom?
Yeah, just think about this. Don't think about where the market is today.
Yeah.
Think about where it's going, because the Wall Street is watching where it's already 6 months out in the future. So just remember that when you make your investments, do it like they do, because they're predicting where it's already going to be and they're going to front run it. And why let them win when you can win?
Amen. All right. Thank you, Brian. And thanks to everyone who watched. Have a good one.
Thanks, everyone.